Thanks for having me. Wanted to start off by explaining what In the Know Trader is and how it came about. So I've been on the street for, dare I say, I think I just started my 38th year on the street. And have had various positions on the street. I started with 12 years trading in the commodity pits, and that's really where I kind of learned the business. And the trading side of the business too, because when ultimately I became strategist at several top firms on the street, including Morgan Stanley, where I was chief market strategist for many years, the fact that I had a very good trading background really helped me understand markets in a way that many people don't, who are pure analysts and who haven't actually traded markets and understand the psychology of trading and how much it has effect or a factor in how markets move. So in giving a little background, I realized years ago, and I'm talking probably in the neighborhoods of 25 plus years ago, this elements of psychology, having been the trader, having realized just even my own emotional influences that affect how I traded, just how important this is. And I realized it couldn't just be for me, it had to be for anybody who was making financial market decisions. And I started looking at a subject that really back then had virtually no material available, which was what today we call behavioral finance theory. And ultimately, over time, I kind of became very well known for behavioral finance theory, not just on the academic side for being able to teach it. So I was the first to teach it at New York University, but also how to apply it directly into the markets. And that's something very few people have been able to do specifically. There are a lot of people who talk about behavioral finance in a general sense, but very few people actually can figure out how to make money with it, with the concepts of it in the marketplace. So there's a lot of people who essentially know the academic side, but very, very few people who've been able to figure out how to increase profits and use the concepts of behavioral finance in trading. So when I started thinking about all these years that I've been a consultant, since I left working for sell-side firms on the street, I've been a consultant for years to institutional clients who make up the bulk of the base that I have, and the businesses that I've always run were to the institutional side. So I talk to hedge funds and long onlys and pension funds all the time, and these are my main clients. But just shy of a year ago, it occurred to me that the individual investor really had very little access to the type models that institutions use to trade the markets. And they're not the typical, even if they're technical traders, most institutional traders are not using the type technical analysis tools that most individual investors use. Will I say that they never look at a 50 or 200-day moving average? No, I'll say they do, but they're not looking at it in the same way. They're often not trading off of them. They're not looking at the crossover the way an individual investor may, and take the idea of a golden cross or a death cross or any of the things that kind of the individual side has named and decided that these are meaningful things. Institutional traders work with a different mindset. And part of it is looking to see what the little guy is doing, and part of it is to see what other institutions are doing. And this is where the role of behavioral finance comes into the marketplace, especially on the institutional side. So when I put In the Know Trader together, I think it was last April that I launched the very first issue. And by the way, you can go to intheknowtrader.com and take a look at kind of what we do and the background that this comes from. The intent here was to provide individual investors access through my writings about the markets to how institutional portfolio managers and traders actually trade the markets. because they're not looking for an overbought signal to sell into. They're not necessarily looking for an oversold signal to buy into, the same way kind of individual investors take technical analysis almost, dare I say, as gospel, instead of the way I look at it, and many of my colleagues do, which is simply a tool to help better time the odds of that what you're doing in the market is slightly better than a flip of a coin, right? In theory, market can move up, it can move down, and of course it can move sideways, but it's essentially a flip of a coin at any given time. So technical analysis helps understand what trends are, if things are in trends, potentially buy into support in an uptrend, sell into resistance in a downtrend. But the institutional marketplace looks at things a little differently. Of course, that basic part they can do. But their focus is more so on trend exhaustion, because any portfolio manager knows the most money is made being correctly positioned for the next move that's coming. And then if they're correctly positioned and that move comes, they can let all the other investors in the marketplace push and create the trend that they foresaw coming. So if you think of, here, let me take an example. If a stock bottoms at $20 and then ultimately rallies to, let's say, 60, and then starts pulling back, you had a $40 move. So if you bought 20 and sold 60, you made 100% of the move. You took out the best you could. The problem is most people and most tools out there that exist don't get you to buy a stock that goes to 20. They probably won't get you long until it's, I'd say, mid-20s. And if something peaked at 60, by the time you realize the peak is the peak, you're probably selling it at 55 or less. In fact, fair to say it's 55 or less. And therefore, most traders and classic portfolio managers on the street, those who are really fundamentally oriented and will only lightly look at charts, tend to miss 15 to 20% of the available move on either side of the greater move, which means at best, they've got 70% to work with. And if you know anything about statistics, 70% represents the first standard deviation of price activity. So they're kind of playing in the fat part of the bell curve. And what I've done and what the better institutional traders do is look to play in the second and third standard deviations of price activity. In other words, play the tails more. Buy when there's blood in the streets, because there's enough information and perspective that's likely darn close to the low, and that we don't need to see, the S&P rally hundreds of points or the Dow thousands of points before we say, oh, that was the bottom, I guess we're in a bull trend. And the same thing on the top. So In the Know Trader was born out of my desire to help the individual investor get access to the way institutional traders think. And again, myself, having been over 3 decades on both the buy and sell side of Wall Street, I come with that type background as well as a real trader's background. And In the Know Trader, yeah.
A question for you,
Sure.
Maybe just for a little bit of clarity here. So when you're looking, at the market and you're looking at, potential bottoms, tops, and so forth, are you looking to get either fully invested in the market or move to cash, or are you looking more at just kind of moving your money around the market, going from maybe one area of the market that's run to another area of the market that's been lagging? So is it more looking at relative strength or looking for reversals in relative strength, or is it strictly, okay, the market's run too far, I'm going to move to cash, okay, now it's come down, now I'm ready to get back in? How would
the answer, Tom, to that is yes to all of them.
Okay.
I will look anywhere and everywhere there is opportunity that presents itself, whether it's in relative terms whether it's in absolute terms. And we'll take a look here. Let me pull up, for instance, let me see if I can get to, let's look at the S&P. So here's a chart of the S&P over the last few months. Here's the all-time high in early October. Here's the low in December around Christmas time, and here's the move since. I'm going to look at signals again, and some of these models are not available to the general public unless you really want to lay out some serious coin. So for instance, one of the models that fits very nicely into the work I do, which tends to be counter trend analysis, is a model by Tom DeMark, which is called sequential. And sequential is a model he developed in the early 1970s. It's been minimally tweaked since. So we're talking, almost pushing 50 years that he first developed this. And it's basically the same model from now that it is now that it was 50 years ago, which shows the robustness of the model, that it didn't need to be continuously tweaked and backfitted. So I understand in the time we have here, I can't walk you through the whole model, but I will say that part of In the Know Trader, besides being a newsletter that I have myself for clients that anybody can join up in, is also every week on StockCharts. On Tuesdays at 3:00, we do a show just like you guys do, but it's called In the Know Trader. So it's a webcast on StockCharts.com that in the last 3 weeks, I have more in-depth explained what this model is so that people can become familiar with it and understand what I'm doing in the Know Trader newsletter. So we do this half-hour weekly webcast on Tuesdays. As is many of the shows, it gets repeated multiple times. It then goes over to YouTube. So these are fully accessible. If you search for my name, Rick Bensignor, on YouTube, you'll see all these stock charts in the Know Trader webcast that we've done. And it's a good way to get a sense of some of these models, how I use them, why I use them, and the type signals they can get. So for instance, without going into all the details, I can tell you that when we get to a 13 count, it often represents a very poor time to be playing the trend in the direction that it had been moving. And often, if you're somewhat aggressive, creates a sense of possibly fading the trend. So just a couple days before the all-time highs, we have a 13 suggesting exhaustion of trend. We've just now rallied significantly. We're through a 62% Fibonacci retracement, which lots of individual investors look at, some, but less so on the institutional side. But we're getting close here on a shorter term basis to a potential peak in price. And I myself did some selling of names that I had bought in December yesterday, knowing that we're awfully close, not having the need to try to time it exactly right, but very willing to take some healthy profits on names that I've been long since mid-December. Excuse me. So this is just one of the models we look at, and again, you can learn more about it. You can look at some stuff online, but if you tune into the last 3 webcasts that we've done for stock charts over the last 3 weeks, I walk you through this model and show you some of the implications of signals that show up. Now, part of In the Know Trader 2 is trying to get you to think more like an institutional trader. And it doesn't happen overnight. It takes time. And part of it is kind of potentially opening your eyes to new and different ways of looking at the markets than a pure 100% technical way, which many people do, especially who are stock charts viewers. They're technicians. And yes, I'm a technician, but I'm also a market timer and I'm kind of a behavioral market specialist. So I'm looking for all different signs of what could possibly be the end of a trend that people will not understand or realize is the end of the trend. The move down in December, even here, if we take a look at the S&P, We know that it took out here. I'll make it. I'll put an ellipse around or something. So here's the February low that had held for the whole year until we broke down in December. And the breaking down, the severity of the breakdown made everybody say, okay, I don't want to say everybody, made many people think we're in a bear market. I've been telling clients for over a month, we are not in a bear market. We were never in a bear market on this move. And this overshot to the downside actually just minimally broke our downside target of 2371 by about 1%. And the day after it does that, the Dow or the S&P rallied, I think it was 115 points. The Dow rallied 1,000 points. And, we were in print to saying this is a low, a solid low, but I can't tell you it's the low. Until mid-January, I came across a different chart, and I think I have it here. Let me see. No, it's in...
I got a question while you're looking this up, Rick.
Yep.
I can see all those numbers in there, almost like counts. Is this similar to Elliott Wave?
No, it's
not at all.
It's actually not at all.
Okay.
So the counts you're seeing here are actually relationships, and it's simple math. The counts are simple math. It's relationship between price bars. A 9 count up, and this is a monthly chart of the Acme All World Index ex-US. This, I'm just using this as an example, but you'll see anytime you go 9 consecutive price bars, in this case it's months, so 9 consecutive months that the close at the last trading day of the month is above the close from 4 months prior, the bar gets a number to it. And it's looking for this to happen 9 consecutive times. If any time along the way, any one of these closes is not above the close from 4 bars back, the numbers drop off, and you actually get a 1 showing up underneath the price bar, suggesting that this close is less than the close from 4 bars back. In order to do this phase of this DeMark model, you've got to minimally go 9 consecutive price bars, close above close from 4 months ago. In the case of a monthly chart, that's often all a market moves before it gets some type of pullback. You don't necessarily know how much it is, but it helps identify, again, potentially a lousy time to be a buyer in an uptrend. The same thing here on the downside that marked the low. Hold on, let me pull this down so we can get the dates in here. Do a little more. So here in 2016, when the market sold off, this happened to conclude 9 consecutive months that the closing price in this ETF, ACWX, was less than the close from 4 months prior. And we move up, we go sideways, but it's only until this part here in 2017 that you actually go 9 months close above the close from 4 back. And we did extend a little beyond that. But what made me turn very bullish in January and help conclude that there was no bear market and there is no bear market coming is that this ETF, which represents the All Country World Index minus the US, right? So this is basically all of Europe and all of Asia, the best markets there. Whereas the US didn't break really until the end of the year. The rest of the world was kind of selling off the whole year of 2018. And we actually got down to 9 consecutive months, starting January, that the close was less than the close from 4 months prior. That happening against the uptrend line that came from the 2009 low, against another element of this DeMark model, which is this horizontal line, said to me right in here that there is very high chance that there is no bear market and whatever decline Europe and Asia had seen is done. So while many technicians are looking to sell into the rally and saying, we've broken down, we took out the February low in the US and keep looking for places to be sellers, all I'm saying to people is we need to find places to be buyers. And when I cut down to shorter term, and that's, for instance, the S&P chart I showed initially, I can see that at least on a daily chart, we're getting closer to upside exhaustion here, which doesn't mean you sell everything in the house, but that you do want to perhaps take some profits. We've had a huge run. in the market since the December bottom, and that we may very well be close to a peak, which you would not see in many other indicators. In fact, I'll tell you that this particular model is, as far as I'm concerned, the single most accurate model there is to calling a trend exhaustion as close to the actual turning point as there is in all of technical analysis. Now, does this model always get it right? Absolutely not. Not a chance. But is there anything that even comes as close to this model and be able to call turns? To my knowledge, no. And I know hundreds of technical indicators. Anything that's based on a moving average is never going to call the turn exactly when the turn comes.
Hey, Rick, do you ever use any, and I'm sorry to interrupt you, but do you ever use any sentiment indicators?
Yes, I do.
Like volatile.
So one of my favorite sentiment indicator, and again, this is a subscription-based, is something called the Daily Sentiment Index. And I include this in my institutional newsletter. So this is a poll from a company called Network Press. Network Press is owned by the very prolific author Jake Bernstein, who has written more books about the markets than any person, I believe, who's ever lived. So Jake's been writing books for 40 years, if not longer, on the markets, has probably 30 to 40 books in print. And his company takes a poll every day after the markets close of about, I don't know, 24 to maybe 30 different futures markets, simply questioning, are you bullish or not? And so the poll results are reflected as percent bulls. And unlike the AAII poll or consensus or any of the other ones, this has to get far more extreme in numbers to potentially be useful. So instead of AAII that says maybe 60% are bulls and 30% are bears and 10% are neutral, and you're saying, gee, 60% is kind of heavy and too many bulls, this generally has to get 85% or above to show extreme reading. And just because one single day gets above, it's not enough for me to fade. But for instance, when oil was up at $76 back in the fall, it was 96% bulls. And that's part of the reason that we were very negative oil in the 70s and telling people not to be a buyer. When the S&P got down to the February low this year, meaning last year, 2018. So we started, we hit the sell-off in January. In February, I think the bullish number for the DSI poll came out at as low as 6% bulls, right? Nobody was bullish. So yes, I do use sentiment indicators to help time exhaustion levels, but they're not the classic ones. And just so this particular poll, the pollees, the people who are polled, are non-professional futures traders, right? So they're the moms and pops, they're the individual investors who trade futures, which tend to be pure momentum players. They may not trade orange juice, but they're responding to what they think orange juice is each day. So they're going to look at a chart, and the chart's pointing up, they're going to be bullish, and the chart's pointing down, they're going to be bearish. There gets to be a point that you get too many people on one side. And again, I've used this poll now for going to be close to 35 years. And it's a very helpful tool. But again, it's not a free poll. It costs money. But I find it particularly useful. So the answer is yes, I incorporate sentiment. I also talk to professional money managers throughout the day. And I'll get their collective thoughts on what they think is going on in the market. And when I hear too many on one side, I'll also look to see what other indicators are saying. Do I have too much bullish consensus in that? Do I have, sequential, this model that we're looking at now is just one of many, many market indicators that exist that I use that combined along with cloud charts and other indicators help me put the picture together. I do want to show, well, we'll still have a few minutes left, what, let's see, where are we?
Yeah, we've got some viewer questions too.
Okay, so let's take some viewer questions. And by the way, here's just like last week's issue of In the Know Trader. So this comes out Wednesday nights. I'll be writing one this afternoon. We look at the U.S. equity market. So again, this is for individual investors. What you see here on the U.S. equity markets is very similar to what I write my institutional clients. We're talking about the VIX range here. So each week we typically look at the VIX and what it suggests. We'll look at market breadth. But here, if you look at a chart of market breadth, you'd say it's ripping to the upside, and there's no reason to think anything else. But notice where turns were called using the sequential model. Back in March, it nailed the low at a time you wouldn't particularly expect the low. It calls the low in October for a rally that lasted a few weeks, and it pretty much calls the bottom in December. So whereas if just you're looking at the breadth figures and saying this stuff's falling out of bed, it's really bearish, I'm looking at this and going, hey, this lines up with the call I'm seeing in the ACWI index that markets are likely bottomed. This is a much better reason for me to fade the move that most people are looking at, and in the way I look at it, exploit the mistakes that they make. And now we're getting much closer to a top. Last week we hit a 13. It's probably a little higher than here, but it's starting to suggest to me, we're kind of late in this piece of the rally that will get some pullback. Are we going back to the lows in December? In my eyes, not a chance. So I'm always going to be looking to be buying dips now. And it doesn't mean we need to take out last year's high in the S&P. We had a 600-point range. Does not mean in 2019 we have to take out the high. But I am looking to be a buyer on any significant pullback. Okay. You mentioned a couple of questions. Let's try to get to them.
Yeah, I was going to go ahead and go through these. I know there was one. I think you mentioned earlier we were talking about standard deviations, and a question came in, why standard deviation rather than ATR, which I'm guessing is average true range.
Average true range is simply a number, a historical number of what the range is over time, and it's done, let's say, on a daily basis. You look at ATR. If it's a weekly chart, you're looking at it on a weekly basis. What I'm trying to say is that here, look at, for instance, this S&P chart we're looking at right here. We bottom at 2345 or so in December. Now we're up near 2750. So the best you could have done was bought the exact low and sold, let's say, today, right? You would have taken out 100% of the move. What I'm saying is most technical indicators are not designed to be able to do that. The best you can do is take out the middle 70%. And 70% is not bad. But if you could have foreseen that this move in here, as bad as it looked, was actually the buying opportunity, then you can take out much more than 70%, and therefore you have a chance to outperform. So if you think of this in terms of how a portfolio manager is benchmarked to the S&P or let's say the standard benchmark, just getting an average return doesn't really help them increase assets. They've got to outperform. And the only way you can outperform is playing the tails of moves correctly, not playing the fat part of the move in the middle. It's really very hard to outperform when you've missed the turns correctly. You'll get the average return, but you can't outperform.
Fair enough. Another question. Since the DeMark sequential is not available to small investors, is the Elliott wave as close as I can get? I'm assuming with your answer earlier, it's really not Elliott wave.
It's truly not Elliott wave. DeMark actually has his own version of Elliott wave, which is purely mathematical. So it takes all subjectivity away for what waves are. But no, this is not Elliott wave.
Okay. Now you've shown a lot of longer term charts, but one question that came in I thought was interesting is, have you tested these signals? Do they work for day trading, or is it more swing trading?
Okay, so let's just pull up. Let me pull up an S&P chart. And let's turn this into a 5-minute chart. And let me take off Ichimoku or some other things just to. So this is real time today. The high of the day is on a 13th, just Didn't know it. Just turned to this chart in response. Here's a couple days ago. Here's a 13 high here. Here's a 13 low here. Here's a 13 low in here. Here's a 13 low here. So you're getting the sense that you really want to be a buyer more than a seller. You start getting a sense of a seller. There's the 13 tucked in here. Goes sideways for, what is this, 5-minute chart? So a couple hours, then breaks to the upside. So yeah, and I can just pick, 20 minutes. You've got the tops in here for a couple days sell-off, and here's a 13 that's not so good, and here's a 13 on today's high. So interestingly, we looked at a 5-minute chart, and it nailed a 13. Counting with two completely different mathematics, you got a 13 on today's high here too, and a 20-minute chart. So you can pick, any market. And yes, this is an incredibly robust model, but you got to realize too that for intraday trading, if you're talking about a day that's a trend day where you tend to, let's say, open near the low and kind of push higher all day long with minimal pullbacks, if you're trading a 5-minute sequential chart, you're going to have probably a fair amount of 13 sell signals that are not going to work because the market's moving up all day. So none of these things you can trade blindly. And if anybody out there tells you there is a holy grail, run as fast as you can, there isn't. There is no model that is always going to get it right. You've got to understand the context of what's going on in the market. And if you're going to fade moves, you better fade a move when it's really close to the exhaustion of the real move, not trading this on a 2-minute chart. If it's a sideways day and the S&P trades, in a 15-handle range back and forth multiple times, you'll get some good trades off. But if it's a trend day, you're going to get hurt. So you've always got to know what mode the market's trading to know which models to use. You don't want to use a trend exhaustion model on a day that's moving or a week that's moving, in one direction.
All right, you're sounding definitely bullish to me, so I think I've probably picked up on that correctly.
Correct.
Okay.
Now, not saying I'm bullish at 2750. Right. But I am as convinced as I can be that the December low was not just the low in the U.S., but the global low. And that's really significant because that means the bear market that existed through most of the rest of the world besides the U.S. last year bottomed in December.
Okay. Do you ever short? I mean, if you get those 13 readings, will you short?
Absolutely. Absolutely. And I'll put on pair trades. Last week, the trade. So each week we put out a new ETF trade. It can be in either direction, or sometimes I pair a trade where you have a long and a short against it. Last week we bought gold and sold silver against it, and that's working. And that's even with the run gold had. I still think gold will outperform silver. So you buy GLD and you sold SLV against it.
Okay. A couple more questions and then we'll wrap up. But one question that came in, you got the Ichimoku clouds there. Is that an important element in your charting?
It's very important. It's so Ichimoku is a little known indicator in the Western world. That doesn't mean nobody knows it, but compared to the Eastern part of the world, they'll pull up a chart with Ichimoku on it the way we would start with a blank bar chart. It is the most basic way somebody in the eastern part of the world will look at a chart. Back in 1997, I came across this model when I was at Bloomberg. It was actually inside the Bloomberg charting system, and it's one of the models I had never seen before. And I did as much homework as I could, and nothing was in English. But having written design models myself, I kind of could figure out most of it. But I actually got a little help from a friend in London who was on the foreign exchange side. And because Easterners are very big foreign exchange traders, he was familiar with it, helped me kind of put a few pieces together I hadn't figured out. And ultimately, I became known as the Western world's foremost expert in this model. I've had 3 book publishers come to me to write the definitive guide, and I actually choose not to because I know what most people don't, and that's a real competitive advantage for me and for my clients. So it is a core model, and I know it very, very well. I've spoken at conferences about it, and in fact, The Traders Expo show that's coming up in New York in in March. I think it's March, whatever the Monday is. I think it's Monday, March 11th. I will actually be doing a very rare public appearance presenting how to use the cloud model. So if you're in the New York area or can get there, I will tell you, come and see it. I will explain to you things that are not known about this model. I do not give away all the secrets, but I will give you enough to use that this will become a useful part of how you look at markets.
All right. One final question, and I know we're not going to have time because this is going to probably be a little lengthy, but what I'm going to suggest maybe is that it could be a topic on one of your Tuesday shows, or maybe when you come back and join us, you can talk about this one. But the question was, how did the model do in 2000, 2008, 1987, 2016? I think the question is getting at, obviously when we've had some very, very difficult markets, how does the model do?
Are we talking clouds or sequential?
I think, well, it doesn't say. I'm assuming sequential.
And so let's say the late 1990s when the market was ripping to the upside, if you use a daily chart, there are plenty of 13 signals that show up, and you basically might be right for 2 days and wrong the rest of the time and get your rear end handed to you. So when you have a strongly trending market, you may very well want much more to be looking at weekly charts than daily charts so that you get less signals and you increase the chance of the accuracy of it. Sometimes trends are so strong that you've got to look at monthly signals. So part of this, again, is understanding what's going on in the market. And if you're going to try to fade a move, you better have pretty good confidence that what you're doing is like either catching a falling knife or trying to stop a runaway train. You've got to really understand risk management and what are the risks involved in trying to do that. And the first question I'd say is, why are you trying to do it? Is it to fulfill your ego and say, oh yeah, I sold it 2 days from the all-time high and stuff like that? You really kind of have to know how and why you're doing it. I can tell you, and if you want, we can finish with this. Only twice last year, Tom, did we tell long onlys, in other words, mutual fund companies that are long, to hedge books. Now, for them, that means rotating to more defensive sectors. For hedge funds, that actually means hedging books. What was 3 days from the all-time high in January, we told people to hedge their books. And then 4 days after what is still the all-time high. Those were the only 2 times we hedged our books last year. And that's from a combination of signals that had me say we are likely exhausted. And from a portfolio risk management point of view, you're much better off putting on hedges and moving defensive than staying with what you have on. So do I always get it right? Nope. I was right about not being long oil in the 70s, but I stepped in too soon at 60 and didn't sell out till 56. That was the worst trade we had all year. Was buying oil at 60 and selling it at 56.
Yeah, that's not bad considering what the market did.
Yeah, it went to 42.
Right. All right, well, it has been a pleasure. Now, I'm assuming that there are ways that folks can contact you and subscribe for your service?
Absolutely. So the best way to reach me, and let me see, here we go. Let's go back. How to contact me. Rick@inthenotrader.com. And again, check out inthenotrader.com, the website, and that's my email. And so if you're interested in subscribing or seeing kind of what we do, check out the website and reach out to me, and I'm happy to help you.
Sounds good. Always a pleasure to have you on the show, Rick. I do want to point everyone towards your show that airs it's Tuesdays, 3 o'clock Eastern, right?
Correct.
Okay. Definitely check it out. I mean, I think the numbers and all that you were showing on here are fascinating. That did predict a lot of the turns. And again, I just want to thank you for coming on and sharing everything with our group here.
It's my pleasure. Thank you, Tom. Thank you, Aaron. I really appreciate being on.
Excellent.
Awesome. Yeah, it is fascinating. I mean, everybody, that's the key in the market, is to try and figure out where's the bottom, where's the top. I mean, if we could figure out those two things, I think the rest would kind of fall into place. It's not easy. It is not easy. That's for sure.
I think we all in the audience can agree with that statement.
No, it is. And I'll tell you, it is far more difficult doing what I attempt to do than playing that middle part of the curve. But if you can figure out how to do it, it is far more profitable. If anybody knows statistics, you know that when you play in the fat part of a bell curve, you might just as much buy high as you do buy low. So that stuff tends to average itself out, and you kind of spin your wheels. The real way to make money is selling that second and third standard deviation and buying the first and second the second and third on the downside, and leaving the fat part of the bell curve for everybody else to push the market in the direction that you're already positioned for.
Well, I'm a professional wheel spinner.
You watch hamsters and you learn from them, right?
Yeah. Anyhow, great having you on, Rick. Really appreciate it. Thank you.
Thanks, guys.
With 3 unique service levels and multiple data plans to choose from, StockCharts.com makes it easy to customize your account to best match your specific needs. In this video, we'll help you explore all the benefits of your membership by explaining our service levels, data plans, and pricing. Let's see how it works. To start, you'll want to choose from one of our 3 service levels: Basic, Extra, or Pro. Each service level represents a collection of features and options bundled together. If you're new to StockCharts, our basic service level is a great place to start. At $14.95 per month, Basic will allow you to create larger, more powerful charts and save them to your account. Next up is our Extra service level, the most popular choice among StockCharts users. At $24.95 per month, it includes all the features of our basic level, plus more saved chart storage and the ability to create custom scans and alerts. If you want it all, our Pro service level is for you. At only $39.95 per month, Pro includes even more storage for your saved charts, custom scans and alerts, as well as faster auto refresh, historical data, and much more. For all service levels, you can choose to subscribe on either a monthly or an annual basis. Our monthly renewal option is similar to most other web-based subscription services. You pay for 1 month of service at a time, and your account will simply renew automatically each month. With our annual renewal option, you prepay for 12 months of service, and we'll give you the 13th month for free. If at any point you'd like to change your service level or renewal preferences, you can always do so from the Your Account page. Now that you've chosen a service level, let's find a data plan that works best for you. Regardless of service level, all StockCharts accounts come standard with our free data plan, which uses BAT's real-time data for the US and delayed data for all other markets. However, if you want to enhance your StockCharts experience even more, you can customize your account by adding official real-time data plans for one or more of the stock exchanges we support. Similar to exchange fees, prices for each plan vary, as they reflect the fees charged by the exchanges for your use of the real-time data. We want to make sure you have the data that's right for you, so our data plans are flexible and can be added or removed at any time. Keep in mind that all real-time data plans are billed separately from your service level subscription and always on a monthly basis. Unless removed from your account, data plans renew automatically at the end of each billing month. If you do choose to remove a plan, the change will take effect at the end of the month. All data plan charges are non-refundable. To explore all our data plans and update your preferences, visit the Your Account page. StockCharts.com gives you the charting tools and resources you need to invest smarter. And now with the flexibility to customize your service level, renewal cycle, and data plans, we make it easy to find the account options that are just right for you. Take control of your investing in just a few simple clicks with StockCharts.com. Simply the web's best financial charts.